Stop what you're doing right now, this second. I don't care if you're in the middle of something important. Drop it. Put down your phone. Tell your boss you'll be back in 10 minutes. Ladies and gentlemen, Asian guy here. It's January 15th, 2026. Something so violent, so unexpected, so perfectly timed that if you don't understand what actually went down, you're either going to lose everything or you're going to hand your wealth to someone smarter than you on a silver platter. No pun intended. We were popping champagne. We were sending congratulations messages. It hit $93.75 per ounce. That's not a typo. $93.75. Not since the beginning of modern markets has silver ever traded that high. Ever. This was validation. This was proof that everything we'd been saying for months was correct. And the shortage was real. The manipulation was failing. The physical market was taking over from the paper market. It was a mathematical certainty. Here's what happened next, and I want you to pay very close attention because the mainstream media is lying to you about what this means. This morning, Thursday, January 15th, silver didn't just pull back. It didn't just correct. It didn't just take profits. It crashed. And I'm talking about the kind of crash that wipes out accounts, that triggers margin calls, that makes people question everything they thought they knew about this market. According to major financial reporting, silver fell from that $93.05 all-time high down to $86.25. Some markets reported losses over 8%. And discovering that your entire retirement account just lost $73,000 for every million you had invested in one day while you were sleeping, traders got wiped out. Now, the financial news networks are on TV right now telling you this is normal profit taking after a parabolic rally. The financial media machine is spinning this as a healthy correction, as traders getting rational again, as the end of speculative excess. But here's what they're not telling you. Here's the part they're deliberately hiding from you. Let me show you what actually triggered this crash. Last night, while most people were watching TV or scrolling social media, the White House dropped an announcement. The administration came out and said that they're delaying tariffs on critical minerals. And yes, silver is on that list for 180 days. According to verified financial sources and commodity analysis reports, the government announced they're going to pursue bilateral negotiations with trading partners instead of implementing tariffs immediately. They're talking about setting up price floors. They're talking about securing domestic supply chains. They gave themselves a deadline of mid-July 2026 to figure it all out. But here's the question you need to ask yourself. If the administration delaying tariffs for 180 days is such terrible news for silver, if it's such a fundamental game changer, then why did the price recover so fast? Because here's what actually happened after that initial crash. Financial reports confirm that the metal rallied back above 90s within hours of hitting that 86.25 low. As of right now, silver is trading around $89 to $90 per ounce. Does that sound like a fundamental reversal to you? Does that sound like the rally is over? Or does that sound like a temporary shakeout designed to scare weak hands into selling before the real move higher begins? Because while the paper price was crashing on Western exchanges, while traders in major financial centers were panic selling, something completely different was happening on the other side of the world. According to major financial media reporting from just 2 days ago, $10. So when Western markets were trading at $86, Eastern buyers were paying $90. When Western markets hit $90, Eastern markets were paying $100. If the administration's tariff delay was such devastating news, if it fundamentally changed the supply-demand equation for silver, then why didn't that Eastern premium disappear? Why are Asian buyers still willing to pay 10 over spot to get physical metal in their hands? Because the physical market didn't get the memo that the rally is supposed to be over. The paper market crashed 7%. The physical market shrugged and kept buying. It was a mirage. It was paper contracts getting dumped while real silver kept getting more expensive. According to major financial analysis and commodity reports, here's what they said. Despite the correction, silver prices remain more than 25% higher year to date, highlighting the strength of underlying market dynamics. Read that again. Despite this crash, despite losing 7% in one day, despite the administration's announcement, despite all the fear and panic, silver is still up 25% in 2026. Even after getting crushed yesterday, we're still massively higher than where we started January 1st. That's volatility inside a parabolic bull market. That's what happens when a manipulated market tries to break free and the manipulators fight back with everything they have. Let me explain something crucial about the administration's announcement, because this is where most people are getting it completely wrong. The government didn't say no tariffs ever. They didn't say we're abandoning the idea of protecting domestic industries. They didn't say foreign producers can export as much silver as they want. They said, not yet. Think about what that actually means. The administration is giving the world especially major exporters, especially trading partners. 6 months to come to the table and make deals. 6 months to agree to secure domestic supply chains. 6 months to diversify away from concentrated production. And if those negotiations fail, if major exporters refuse to play ball, if countries won't agree to the government's terms, then the tariffs come back. And they're going to come back harder than anyone expected. So here's what's really happening right now. Because they know they have 6 months to secure as much silver as possible before tariffs potentially make imports 25% or 50% more expensive. Major tech giants aren't sitting back relaxing. They're calling every supplier they have right now, trying to lock in contracts. Smartphone manufacturers aren't celebrating. They're hoarding metal. Solar panel makers aren't taking a break. They're buying everything they can get their hands on. Now let me show you why the administration's delay doesn't actually solve anything. According to commodity market analysis from today, here's what they said. Strong demand from the solar, electrification, and electronics sectors continues to absorb available supply. At the same time, global mine production remains constrained. Did the government's announcement magically create new silver mines? No. Did it suddenly increase production from existing mines? No. Did it convince major exporters to lift the export controls they implemented on January 1st? Absolutely not. The physical shortage that was driving silver to 93.75 did not disappear just because the administration delayed tariffs. Major exchange, registered inventory, the actual silver available for delivery, is still down 70% from 2020 levels. That's verified data. The vaults are still empty. The dealers are still sold out. The mints are still backlogged. Financial reports confirmed that leading exporters placed export controls on the metal in December. That silver is trapped in those countries. It's not coming to Western markets. The government can negotiate all they want. These countries aren't selling. So when the administration talks about securing domestic supply through negotiations, where exactly is that supply going to come from? Latin American producers are running low. South American mines are maxed out. Pacific producers are struggling with production costs. Where's the new supply? It doesn't exist. And 180 days won't make it magically appear. Because when you look at the timing, when you look at the volume patterns, when you look at who benefited from this crash, it becomes crystal clear. Silver hits an all-time high of $93.75 on Wednesday afternoon. And then, just hours later, the administration makes their announcement. Not the next morning, hours later. Or maybe someone knew that announcement was coming and wanted to maximize the damage to silver prices. Look at how the crash happened. According to market data, the selling started in Asian hours with massive volume spikes. That's not retail investors calmly taking profits. That's algorithmic trading. That's institutional players dumping positions. That's coordinated selling. The major financial institutions who are short silver, the same institutions who've been fined hundreds of millions of dollars for manipulating silver markets, the same institutions who are sitting on massive short positions that were underwater when silver hit $93. So they used the administration's announcement as cover to dump paper contracts, trigger stop losses, create fear, and manufacture a crash. Why? So they could cover some of those shorts at $86 instead of $93. So they could buy back positions from panicking investors at bargain prices. Major analysts noted that experts say the medium-term case for silver remains constructive, supported by supply shortfalls, industrial demand, and spillover interest from gold. The smart money didn't panic. The smart money bought the dip. The physical buyers in Eastern markets kept buying. The industrial consumers kept securing supply. The manipulators crashed the paper price, but they couldn't crash reality. Let me show you the mathematical proof that this squeeze is still alive. The data point that proves yesterday's crash was artificial. Backwardation. If you don't know what that word means, let me explain because it's crucial. In a normal commodity market, futures contracts that expire further in the future cost more than near-term contracts. Why? Because of carrying costs, storage, insurance, interest. It costs money to hold physical metal over time, but when there's a physical shortage, something weird happens. The market flips. Near-term contracts become more expensive than long-term contracts. That's called backwardation. And it only happens when people are desperate for immediate delivery. If the government's tariff delay had solved the supply problem, if it had fundamentally changed the equation, the backwardation would disappear. The futures curve would normalize. But it didn't. As of this morning, near-term silver contracts are still more expensive than distant contracts. The backwardation is still there. That means the shortage is still real. The physical demand is still overwhelming supply. The squeeze is still on. The major institutions can crash the paper price all day long, but they can't fix the backwardation. They can't make physical silver appear in empty vaults. They can't force industrial buyers to stop consuming metal they desperately need. Now let me tell you what's coming next, because this is where it gets really interesting. Over the next few weeks, maybe months, we're going to see more of this. The paper market is going to fight back. Major institutions might try to crash silver again. They might coordinate another dump. They might try to shake out more weak hands. But every time they crash the paper price, physical buyers are going to step in. Eastern markets are going to keep paying premiums. Asian buyers are going to keep hoarding. Industrial consumers are going to keep securing supply for the next 6 months before potential tariffs hit. And then something's going to break. Maybe a major dealer can't source physical silver to meet demand. Maybe tech giants or automotive manufacturers publicly complain they can't get the metal they need. Maybe a large fund stands for delivery at major exchanges, and those exchanges can't deliver. Whatever the catalyst is, when it hits, the paper price is going to snap upward violently. We're talking about a $20, $30, maybe $40 move in a single day. The market's going to realize the paper system is broken and only physical metal matters. The price is going to explode. Leading investment firms told financial media it is absolutely possible for silver to hit $100 in 2026. Some analysts are talking about 150. Top strategists are still projecting 375 by 2028. I think we hit $100 by August. I think we hit $150 by year end. Because when the government officially designates silver as a strategic national security metal, when they prioritize domestic supply for defense and infrastructure, when they restrict imports, the price goes vertical. So let me tell you exactly what you need to do right now. And I'm not giving you financial advice, I'm not your advisor, but I am telling you what I see in the data and what I'm doing personally. If you own physical silver right now, coins, bars, rounds, sitting in your safe or in allocated storage, don't sell. I don't care that the price dropped 7% yesterday. If you own silver ETFs, you need to seriously evaluate your risk. Some popular ETFs are custodied by major financial institutions, the same institutions that have been fined for manipulating silver markets, the same institutions that are massively short silver. Do you really trust them to have the metal when the squeeze happens? Or do you think they might cash settle your position at $86 while physical metal trades at $130? Some ETFs are safer because they're held at reputable facilities with better redemption terms. But even those could face government intervention in a crisis. The only guaranteed safe option is physical metal in your personal possession. If you don't own any silver yet, and you've been waiting for the right time to buy, this is it. Silver just dropped from $93.75 to $86.25. That's your discount. That's your entry point. That's the market giving you a gift before the real explosion begins. Don't wait for the price to drop to $70. It's not going to $70. The physical market won't allow it. Don't wait for mainstream media to tell you it's safe. Don't wait for your advisor, who probably does not own an ounce of silver himself, to give you permission. Call a dealer today. Place an order. Yes, you're going to pay premiums. Yes, you might pay $92 to $95 all in when spot says $86. Yes, there might be delays. Accept it. Because in 6 months, when spot is at $150 and dealers are completely sold out, when there's no metal available at any price, you're going to wish you had paid $95 today. Let me give you one final piece of evidence that this rally is far from over. A well-known financial author just posted about this. He said, millions of silver investors are selling as prices go up, and warned that sellers will crash the silver market temporarily before it begins climbing again. Even the weak hands who are selling recognize this is temporary. Even the panic sellers know it's coming back. Major bullion dealers in the country reported that December saw a record, relentless deluge of profit-taking in silver, with sell orders overwhelming exceptionally light buying volumes. You know what that tells me? The weak hands already sold. The retail panic sellers already got shaken out. And now the smart money, the people who understand what's actually happening, are buying from them at discounted prices. This is the final shakeout before the real move. This is the bear trap before the bull market resumes. Here's my final message to you, and I want you to really hear this. Yesterday's crash didn't change the fundamentals. It didn't create new supply, it didn't reduce industrial demand, it didn't fix the shortage, it didn't make major exporters start selling again, it didn't refill the exchange vaults. All it did was create temporary fear in the paper market while the physical market kept doing what it's been doing, paying premiums, hoarding metal, and preparing for what's coming. The $10 Eastern market premium that major outlets confirmed? Still there. The backwardation? Still there. The exchange inventory depletion? Still there. The export restrictions? Still there. The industrial demand for solar, EVs, and electronics? Still there. The government gave the market 180 days to prepare for tariffs. But they didn't give the market 180 days of new silver supply. They didn't solve the fundamental problem, they just delayed the inevitable. The paper market crashed 7.3%. The physical market barely noticed. That tells you everything you need to know about which price is real. This is John A.G. from Currency Archive. Today is Thursday, January 15th, 2026. Silver crashed from an all-time high of $93.75 down to $86.25. The administration delayed critical mineral tariffs for 180 days. The mainstream media is telling you the rally is over and the speculation has ended. But the verified data says something completely different. Eastern markets are still paying $90 to $100. Physical premiums are still elevated. Backwardation is still present. Industrial demand hasn't changed. Supply deficits haven't changed. And experts still expect silver to hit $100 in 2026. The paper market can crash, the algorithms can dump, major institutions can manipulate, but the physical market has already decided what the real price is. And that price is going higher. If you hold paper silver, think about converting to physical. If you hold physical silver, don't let anyone scare you into selling. The real price is ain't 86. It's not even 93s. The real price is what desperate industrial buyers are going to pay in 6 months when they realize government negotiations failed and the shortage got worse. The target is still $100, $150, potentially $375. The timeline just got extended by 180 days. But the destination hasn't changed. The paper market can throw tantrums. The physical market has already won. This is John A.G. Remember to like, subscribe, and share this. Get out of paper promises. Get into physical reality. Before the government's 180 days expire. Before bilateral negotiations fail. Before tariffs actually drop. Before industrial buyers realize they're running out of time. Before the price goes vertical. Do it now. Go, 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 go.